Hey everybody, welcome back to another edition of 5 Question Friday. That's where I do my best to answer questions that you all send in. If you'd like to send in a question, the best way to do it is to subscribe to the newsletter. You can you'll see the link below this video. It's a free newsletter. I send it out every Sunday morning, and it includes a link to a Google form you can fill out with a question. So with that, let's dive right in. We're going to look at the 5 questions of today. The first one, which I found fascinating, will fake inflation data destroy the value of TIPS, Treasury Inflation Protected Securities? How should a pension affect your asset allocation? Do advisors really add 3% to your returns in terms of their value add? We talked about TIPS ladders, but this viewer wants to know, hey, can I just use a TIPS fund? Why do I have to build a ladder? And then finally, when we're investing, should we invest differently or the same between Roth retirement accounts and traditional retirement accounts? So that's what we're going to tackle today. 5 great questions. So let's get to it. This first one I find fascinating. So this question, the viewer sent it in, and it comes from this article by Paul Krugman. Paul he won a Nobel Prize in economics. He used to write for the column for the New York Times. Now he's got his own Substack. And the thing we have to keep in mind about Paul, and you'll see an example of this, he speaks his mind when it comes to politics. He's no fan of Trump. I think generally he's no fan of conservatives. And of course, many of us have political opinions, but they come through in his writing, I'll just be honest here, in a way that causes me not to fully trust what he's saying. But that doesn't mean he's wrong. And so I have to sort of grip my teeth and get past all of the political nonsense to get at the heart of the issue. And sometimes, it's quite interesting. I think it's an interesting question. Anyway, enough chit chat. I'll show you what the issue is. So he points out, at first with Argentina. Apparently, Argentina admitted that it faked its inflation data for 7 years. Now, I'll leave links to everything below the video. I followed this link here. Apparently, when they were doing this, everyone sort of knew they were doing it, but eventually they came clean. And but he brings that to the U.S., and specifically with TIPS. And he describes what TIPS are. They're Treasury Inflation Protected Securities, and the principal balance of a TIPS bond goes up based on the Consumer Price Index. But here's where we sort of get to the issue and politics. He says, and it's this paragraph right here, TIPS protect you against future inflation that the U.S. government admits is happening. I would take issue with that. It's calculated based on survey data, and of course Paul knows this, based on a method for Consumer Price Index. They're not just sitting around saying, how much inflation do we want to admit happened last month? But this is just where I think he's being colorful in his writing. Fine. That has never been an issue in the past because despite claims from, and again, here we get into politics, right-wing conspiracy theorists, America has never cooked its economic books, but there's a first time for everything. And so that put folks thinking, well, wait a minute, Rob, and they emailed me. Yeah, we really depend on the CPI number because that's a big component of the value of a TIPS bond. And think about a TIPS ladder. What if President Trump, or I suppose a future president, cooks the books, right? What if they say, they may know that inflation's 7%, but they're going to have a CPI number that's just 3%. Well, a couple of things here. First of all, and he used the term right-wing conspiracy theorists. I did some research because I thought, well, have there ever been views that the CPI number is either wrong or not a good measure of inflation? And are those, if there are they always from conservatives? It turns out no. Conservatives have issues with CPI. Democrats have issues with CPI, often for different reasons. Democrats often have issues with CPI because, for example, they say it understates the increase in housing costs, or it's insufficient to keep up with inflation for the elderly, and so we should use something else to adjust Social Security benefits. In fact, Senator Warren and Bernie Sanders introduced legislation to that effect. I don't think it went anywhere, but the point is this idea that politicians view the CPI as an inaccurate measure of inflation is in and of itself nothing new. Maybe there are different motives depending on their political perspectives, but there you go. I think the real question is, how could a president manipulate that number? Well, I'm no expert on that. I certainly know that if they went in and there was a change to the way CPI was calculated, we would all know that. And economists and pundits and politicians and you and I could all debate whether that's a good thing or a bad thing, but it wouldn't be something hidden. And so in my mind, of all the things I have to worry about in life, and particularly with investing, Paul Krugman's concern that the current administration is going to cook the books and understate inflation is, at least at the moment, not high on my list. Okay, I'll leave a link to that article. You can read it. You'll form your own opinion. All right. Question number 2. Thanks for all you do. I've retired. I've got $1 million pension, $2 million in investments. Is it correct to look at my pension as a fixed income investment? If so, I could convert all my investments to stocks, and I'd essentially have a 70% stock, 30% bond, or fixed income portfolio. Your thoughts? So number one, there are a lot of folks that would say, yes, that's exactly how you should look at it. They might say you should look at Social Security the same way. That would be part of your, if you had get Social Security benefits, that would be part of sort of your fixed income allocation. You might even add annuities in there. I would say a couple of things to that. It's not my preferred approach. The first thing I would say is I would consider where the pension is coming from, because there could be some risk that the pension fails. Now, it may be coming from the federal government, in which case you may say it's just as reliable as, a U.S. government bond, but it may come from some state entity or educational institution. So it just depends. You want to think about the risks to a pension, or an annuity for that matter, that comes from an insurance company, depending on the amount of the annuity and your state protections. The potential risk could be very different than, say, a U.S. government bond. So that would be something to keep in mind. But the other thing I would say, and this is how I look at it, is to me, the asset allocation you want for your retirement savings, so in this case, the $2 million from this viewer, it depends in large part for me on how much of that savings I'm going to pull out every year. Now, he's got a nice pension, that's great, but how much is he going to be taking out of his savings? And if it's, let's imagine, somewhere in the 4 to 5% range in year one, maybe adjusting for inflation, and he puts all $2 million in stocks, at least history tells us he could run into problems. And particularly if we repeat 1929 to 1931, where stocks lost 90%. Now, of course, it depends what stocks he's invested in. He could have international, he could have REITs and other things. But at 100% stocks, you are risking, or accepting the risk that we could have a really, really bad a stock market like that again. And I think it's absolutely possible that we could. I'm not, of course, predicting that. And it probably wouldn't look like 1929. It would be something totally different that caused it, I would think. But we could. And at least in Bill Bengen's research on the 4% rule, he said that if the safe withdrawal rate is your main concern, you really want to be somewhere between 50 and 75% in stocks. I think subsequent research has confirmed that. I would, in my view, the closer to 75 probably the better, recognizing that no matter what you do, there's always risk, and the future might not look anything like the past, and you all know that. So that's how I look at it. I don't actually try to convert guaranteed income into some fixed income allocation in my portfolio. I look at our retirement savings separately. I ask, how much am I going to have to pull from that? And then given that, I think about my asset allocation. Now, if this viewer said, well, Rob, I'm only going to spend 1 or 2% each year from my savings, then frankly, you've got all kinds of options in terms of your asset allocation. At least historically, yeah, 100% stock portfolio would be fine. Again, keeping in mind that history doesn't always repeat itself. All right, great question. Next one is, do advisors really add 3% returns? And there's sort of a long question here, but this comes from, I'll show you, comes from this report study from Vanguard, and it's 46 pages long. So we're not going to look at it all, but I will link to it and you can check it out. But this is a good summary. This report said, look, there are a number of things that advisors do, and I'll let me just take my picture off there so you can see the whole thing, that add value. And so just as an example, they'll rebalance for you. And that adds, according to this paper, 12 basis points in value. There's behavioral coaching, which is basically keeping you from selling all your stocks when the stock market crashes. And that can be 200, which would be 2%. 100 basis points is equal to 1%. So this would be 2% or more. Asset location. So that the idea is, what investments do you have in which account types? Taxable, tax-free, tax-deferred. And that can be up to 0.6%. Tax-efficient retirement strategy can be up to 100 or more, and so on. And they sort of came up with these numbers and added them all up and said, yeah, 3% in net returns. And so advisors often cite this. And I think this has virtually no relation, or almost no relation to reality at all, for a couple of reasons. The first is, many of these things are sort of one and done, right? You don't need ongoing advice. They tell you, okay, here's how you should invest. Imagine you just went to an hourly advisor or a flat fee advisor, and they say, okay, here's a good portfolio for you. I suppose you might want to get it reviewed, I don't know, once every 5 years, but it's not like you need someone to ongoingly look at the 3 ETFs you've put in your portfolio, or the 5. Same thing with asset location. Once you understand what kind of investments go where, you don't need ongoing help with that. Rebalancing, it's not a big part of their what they call alpha, this 3%, but it's not hard to do. I get that some people might not want to do it. You can also create portfolios that will, with balanced funds and the like, that might rebalance for you. Probably the most important one is the behavioral coaching. I do think this is very important, but here is where I think the study kind of goes astray, and in particular where advisors use this study in the wrong way. Behavioral coaching can be extremely important, particularly if you have an advisor who can help you stay the course. Just like Jack Bogle said, stay the course. I've said it 100,000 times, stay the course. And an advisor can help you do that, particularly when the market's down 10 or 20 or 30%. But here's the thing. They don't need to charge you a percentage of assets under management. They don't need to say, for this behavioral coaching, I want 1% of your wealth every year for the rest of your life. That makes no sense. There are plenty of hourly fee advisors and flat fee advisors. I have a list of a few, and I'll link to it below the video. So even if there is value in that kind of behavioral coaching, and I think there is, I think trying to translate that into it's worth 2%, I think is just a guess. I suppose there might be some way to try to get at it, but the reality is how valuable that's going to be to you specifically, there's no way to know, and certainly this study isn't going to answer that for you. And I think that's the big part that gets missed in this study. And so what some advisors will do is say, hey, yeah, I charge 1%, but hey, look at this study from Vanguard. I can save you or increase your returns by 3%. So it's a good deal. And I just don't think that's accurate. It's certainly not a reason to pay 1% of your wealth to somebody every year. And it's interesting to me that who else does this? You go to an attorney and you get complex trusts set up and wills and end-of-life documents. Can you imagine if they said, okay, that's great. Now, this will cost you 1% of your 401k balance for the rest of your life. That is insane. So I don't know why we would do this with investment advice where the advisor is going to spend 1 or 2 hours a year, which is about what they're going to spend. Now, I get it. It's not just about time. They're also bringing a lot of expertise, but still, forking over 1% of our wealth every year for this, I think, is just insane. All right, that's my take on that study. I'll link to it below the video, and of course, you can read it for yourself. All right, this next one, good question. The idea is, why use TIPS ladders? We can just dump everything into a TIPS ETF, and let me just pull up, so that we're all looking at the same thing here, I'll pull up an example. I'll just use the iShares TIP ETF, which is conveniently has a ticker symbol of TIP. All right, here it is. And it's not the least expensive TIPS fund, but it's 19 basis points. And if we go to the portfolio, we can see that it's got a maturity and duration of, we'll just call it 7 years. And so understand what that means. That means that this is going to invest in a lot of different Treasury inflation protected securities that have different maturities, right? In fact, we can look at them. Here we go. We can see, right here, some mature in 34, 33, 32, 29, 27, all the way down. We might get, here's some that mature, next year. But when you sort of add them all together and how much the fund has in each, you get sort of an average maturity and duration around 7 years. So the question is, how does this compare to a TIPS ladder? And we can take a quick look here. This was the site that I showed you in a video a few days ago. And we'll just quickly build a TIPS ladder. Let's just say we want 40 grand or thereabouts, close enough. So let's just say we want to do a 30-year TIPS. So the idea is we're going to retire at 65. If we can get $40,000 a year after inflation, that'd be great. And so what's that going to cost us? It's going to cost us $890,000. And so the thought is, well, to build this ladder, and we can generate it, and then we can look at the purchase list. I got to go through and buy all these individual. I got to buy 25 of this. This is a CUSIP number that identifies the specific bond. I got to buy 25 of those and 26 of this and all the way down. Goodness, why don't I just take this money, this 800 and some thousand, and dump it into a TIPS bond fund? Well, and then just live off that. That seems a lot easier. Well, it is easier, and it could work out fine, but it's not quite the same thing, because when you build that TIPS ladder, let me just go back to it here, you know what you're going to get. You know what the yields are right now on all of these TIPS, and because the principal balance of the bond goes up with inflation, and then as that balance goes up with inflation, the interest gets calculated against that higher amount, and then when the bond matures, you get all of that back, including the inflation adjustments. You know that you're going to get exactly what you're going to get every year for the next 30 years. And in fact, and this is something that this site added recently, you can actually look at it. We could say, okay, let's see here, 2045, this is what we're going to get. And let's see here. In February, specifically February 15th, we're going to get this amount adjusted for inflation. We don't know what inflation is, but whatever it is, let's hope that the government doesn't muck with the numbers. Whatever CPI is, that'll get adjusted, and it's going to be from a maturity, which means these particular bonds, you bought 28 of them, will mature February 15th. You'll get this amount plus inflation. You'll get this amount in interest adjusted for inflation. And these are the bonds you'll get it from. I mean, it's very, very specific. And then in August, you're going to get some more money from interest, and there it is, right? I mean, you literally know that level of precision, okay, with a bond ladder, TIPS bond ladder. You don't know that with this fund, right? We know what the yield is right now, and it's the SEC yield is 1.88. That's the yield based on how the interest it's been paying over the last 30 days. That's the yield, and of course it's after inflation, right? Because we know these are TIPS bonds, but that's the yield. We know that right now. But that's going to change. It's going to change every day, and if interest rates go up, that can affect the value of TIPS bonds, right? Now, in the case of the ladder, it's going to affect the value of all of these TIPS, but we're probably not going to sell them, right? We're going to hold them to maturity. At least that's the idea of a TIPS ladder. But with this fund is constantly buying and selling TIPS because they want to keep the average maturity and duration of their fund around 6 or 7 years. So depending on what interest rates do, the value of this fund can go up or down, and it will. And you could end up needing to sell to get your money out for the year at a time when the fund is down, right? Of course, you could also do it when the fund happens to be up. You just don't know, and you probably, over the course of 30 years, you'd probably do both. And these are, because they're roughly a 7-year maturity, average maturity or duration, you don't have that protection out the full 30 years like you do with a ladder. Now, could you still do this and everything work out fine? Sure, I think you probably could. And maybe the worst case isn't too terrible, but that's really the difference, the level of control you can have and knowledge you can have about what the outcome is going to be. You can really dial it in with a tips ladder. You can't with a tips fund. It's just not possible. I will mention briefly this product. This is from iShares, BlackRock. They have ETFs that act like individual tips, and they offer them from 2025 through 34. And the way these funds work, you invest in these are ETFs. We can look at one. And when it gets to the end of 2026, it will basically just close the fund and send you all your money back, kind of like a TIPS bond maturing, right? There is an expense ratio, it's 10 basis points, but the other thing is you can only build a 10-year ladder with this because it only goes out to 2034. You can't build a 30-year ladder, but I thought I'd mention this to you. But that's really the difference. It's not a question of TIPS ladder being better than a TIPS fund. They kind of function in different ways. And so a lot of it just depends on what your goals are and what level of certainty you want to have. Okay, great question. Last question. Good morning. I've recently found your channel. I was wondering what types of investments would be more suitable for a Roth IRA versus a traditional IRA. It's a great question. So first of all, from a tax perspective, I want to keep bonds out of taxable accounts because they generate interest every year. You don't have to worry about that with a retirement account, and that's true whether it's a Roth or a traditional, right? When investments earn interest or dividends, they don't get taxed. The tax comes, at least in the case of a traditional IRA, when you pull the money out. But there are some differences, obviously. With a Roth, assuming we follow all the rules, when we pull the money out, it's tax-free. With traditional, when we pull the money out, it's treated as ordinary income. And then, of course, traditional IRAs are subject to required minimum distributions. They start at 73. Eventually, that number is going to change to age 75. And that's going to, when those kick in, you're forced to take money out of your traditional IRA each year, even if you don't need it. Now, you don't have to spend it, right? You can just take it and put it in a taxable account, but it is going to be treated as ordinary income in the year it comes out, whether, again, it's by choice because you choose to take it out because you want to spend it, or it's an RMD and effectively the government's forcing you to take it out or you get penalized. And so because of those differences, I like to do a couple of things. I like to keep as much of my bonds and fixed income in a traditional IRA. And I include stocks in the traditional IRA as well. It depends on how much money you have in the traditional IRA versus other accounts. Stocks in a traditional IRA I think are great, but to the extent I'm going to have fixed income in my portfolio, I like to keep it in a traditional IRA and fixed income. And then for stocks, again, they can go in a traditional IRA as well. But for me, I want to keep 100% of my Roth money, again, if I can, in stocks. So why? With the traditional, eventually we're going to encounter required minimum distributions. That number is calculated based on your age and the balance of your, in this case, traditional IRAs, December 31st of the previous year. We know that long-term fixed income, they're not expected to grow as much as stocks. And so, again, anything can happen, but that's sort of generally true. And so if I'm going to have investments that don't grow as fast as stocks, and that may make good sense to have them, I'm not going to put them in a traditional IRA just because of RMDs. But if I'm going to have fixed income in my portfolio to sort of give some safety and some stability to the overall portfolio, by keeping them in the traditional IRA, I end up decreasing the RMDs that I'll eventually pay because, again, bonds, fixed income don't tend to grow as fast as stocks. On the other hand, since a Roth is tax-free, I want to get that as big as possible. So I want the growth. So that's why I like to put stocks, and that would include REITs, for example, in Roth IRA accounts. Now, I will say there could be times when that's just not possible, right? So let's imagine you've got 50% in traditional, 50% in Roth, and that's it. You don't have very much in taxable, and you want a a 60-40 portfolio. Well, if it's 60% stocks, then fine. You put 50% of the stocks, you'd fill up the Roth, you'd put the other 10% in the traditional along with the 40% of bonds. But what if you wanted 50-50? You say, okay, Rob, that's fine, right? 50% stocks go into Roth, good. 50% go in traditional. But what happens if stocks take off and now you've got to rebalance? Or better, actually, for our example, let's say bonds take off. You've got to rebalance in such a way and you don't have enough money, say, in the traditional to cover all the bonds you want. Or another way to think about it, maybe as you move into retirement, you want to even get more conservative and you want 60% in bonds. Well, you got to put some in your Roth account to accomplish that. That's really the point I'm making. Asset location is very important, and it's important what you put in taxable accounts, and I think this difference between Roth and traditional is important. But it's not the only thing that's important. And a proper asset allocation is important too, and there could be circumstances where you can't follow these rules to a T. And if I had to put some fixed income in a Roth account, it wouldn't be the end of the world. Okay, so that's at least my take. But if I'm able, I want to keep my bonds, fixed income in traditional. I can have stocks in there as well. And then for Roth, I want 100% stocks. Well, there you go. Those are the 5 questions. Always great questions that you send. And as I mentioned, I'll link to the newsletter below the video. That's where you can, you'll see the link. You can send in questions that I'll cover in a future video. If you have any questions about this video, leave them in the comments below. Be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.